break down a stock charts trading alert. First will be the ticker. With the ticker, we'll give you the current amount that the stock is trading at. Right underneath that, we'll give you BE, which is break-even amount, and that will be determined by the strike of the option. Next, we'll give you the month of the expiration of the option that we're choosing. Then we'll show you which calls we're selling, the 145. C stands for call. Minus stands for selling this portion of the call spread. Then, for protection, we're going to buy the plus sign, the 150 call strike price, and C for calls. STO stands for sell to open. We're going to put it in as a limit order for $2.50. And on that limit order, it's good till cancel, GTC. And at the bottom, we'll put in our target price, which will be 50% profit. BTC means buy to close, and GTC, good till cancel. So that way you don't have to sit in front of your computer all day. These are all going to be bear call spreads. That's why you see the minus first, or you have the sell to open first. Then you're going to be buying the position back at a lower amount of money, collecting the premium. So as here, you can see live alerts. CLDX was at 43.43 and the break even was at 42.50. We're using the August monthly expiration dates, selling the 40 calls, buying the 45s for protection in case it goes higher. STO, sell to open, $2.50, good till cancel, so we don't have to wait and get in at a cheaper price. Either it gets us in or it doesn't. And that's what I mean sometimes by not being filled. We put a demand on the market, not allowing the market to put a demand on us. And this is the closing price, $1.25. Limit order has to hit that number for it to execute the trade. Buy to close, GTC. Sometimes in the alerts, you'll see this, double down or first entry. Depending on when you enter into the alert service will be how you handle the trade. We called MOXC a couple weeks ago and it went higher against us. So we're doubling down our position. You could see that MOXC is almost at $30 and this break even is $27, meaning we're expecting price to go under $27 by August 20th. But that does not mean that we have to wait that long to collect profits. Sell the 25 calls, buy the 30 calls for protection. And you see here, we went a little aggressive, not necessarily a one-to-one trade, at $2.45. You can see the spread is a $5 spread. So a one-to-one trade would be $2.50. So right now the ratio of this trade is probably around a risk factor of $105 to a max reward of $95 and our target price. So now let's match up the trade alert with the actual chart. So here's Apple at $145. Right now you can see Apple's at $144.66. Coming up into resistance, so we think it will sell off from here. At least go low enough to make the handle part of this cup and handle. Now about BE, which is break even. We're expecting all of these trades to go down. So when you see that the break even price is higher than the current stock price, that means you have extra protection. So remember when we said the stock price was at $145 when we were looking to enter into this trade. And since then it's gone higher, all the way up to $150. And that's a good thing about having a higher break even, meaning price can even go up, but just as long as it closes below that 147.50 mark before expiration, we'll make our profit. Not that we have to wait that long to make our profit. We can exit this trade early. Next is the expiration date. We're using August 20th here. In this trade strategy, we use the monthly expiration that happens on the third Friday of the month. August 20th. I'm not putting the year in because we only go 4 to 6 weeks. So depending on where we are in the month will depend on which expiration month I pick. Obviously, if we're on the 5th of July, that doesn't give me much time. So I need to pick the following month to give me the right amount of time to make sure everything works out. Now for these numbers here, that will be clarifying the option strategy that we'll be using. Sell the 145 calls and buy the 150 calls. Now when you go to your option chain, you might have a tab that looks like this. Hopefully your brokerage firm gives you a long list of option strategies to be able to choose from. If not, Google how to level 3 options and pick out your firm, either Webull, Robinhood, E-Trade, and find out how to level 3 so you can do these credit spreads. These are bear call vertical credit spread trades. That's a mouthful. This is the option strategy we use when we think price is going to decline on an underlying asset. This is done by purchasing a call option at the specific strike price while also selling the same amount of calls at the same expiration date. And the calls that we're selling, we want to be at a lower strike price. And you will receive a credit when placing this trade. You can do this from a single legging in to the first position and then buying the second position. Meaning you would go to the call side of your option chain, find the 145s and sell that side of the option. That would be leg 1. Leg 2 would be find the 150s and buy that side for protection. The next way is use vertical, and it basically creates the strike price spreads for you. Just remember, when you're on the calls, the bid is sell. See how the word sell comes up as you hover over this mark? And then on this side, the ask, as you hover over it, it means buy. But when you have the vertical spread set up, you just click on here and it will place the trade for you. So let me give you another visual. This is selling the 145 calls. And here you will see -1 means sell the 145 calls. Then the other side, which is the protection, is buy +, the 150 calls. And here you are, +, the 150 calls in the month of August. So now we come over to this side of the trade. This is a credit spread, and you can see price is $1.97. Mine is already set to a limit order. You'll want to do the same. And then you see this here, day, and it needs to be changed. Back to the trade setup alert, and we see it says $2.50, and we were only at $1.97. STO and GTC, good till cancel. That's what the difference is between day and good till cancel. So we need to raise this price up to $2.50 and change this to GTC. So let's look at the way the current setup is. They're wanting to give you the trade for $2, meaning your max loss will be $300 and your max profit will be $200. Your break even is $147. But if you move this up to $2.50, like the alert says, limit order, good till cancel, then press your confirm and send, the order should change. Now you have a 2-to-1. Instead of spending $300, you're only spending $250. Instead of only making $200, you're making $250 potential. Instead of the break even being at $147, now it's at $147.50, giving you 50 cents more upside protection. Once you confirm everything, push send. Now it will be in your working orders, waiting to open, sell the 145s, buy the 150 for a limit credit spread of $2.50. GTC until it gets filled or you decide to take it off. Once that open position is filled, red, sell to open, Apple, you can click on it and push create opposite order. You don't have to do this right away. You can wait until you get home from work. And this is the last of the alert, closing out the trade. And now you'll see that it will be green because you're buying it back. Green means buy, red means sell, and you're going to put in good till cancel so you don't have to sit and watch the computer. So you'll change the price to $1.25 to give you that 50% profit target, limit order, good till cancel, and confirm. And that's the basic rundown of our alerts. As you'll see, there's lots more videos to kind of walk you through some of the decision making of everything. You can do exactly as we do, or you can tweak the system to meet your needs.